Only 10 days remain, and the silver market is staring at a moment that could change everything. On February 27th, traders holding March silver contracts must choose roll forward, close out, or demand real physical delivery. And here's the shock. For the first time in modern history, the numbers don't add up. Hundreds of millions of ounces are promised on paper, but only a fraction actually exists inside the vaults. This isn't just another market event. This could be the biggest silver delivery crisis in decades. Stay with me, because what's coming next is bigger than anyone realizes. To understand why February 27th is creating so much tension in the silver market, you need to understand how the futures delivery system actually works. COMEX silver contracts trade every month, and each contract represents 5,000 ounces of silver. In theory, these contracts allow traders to either profit from price movement or, if they choose, demand real physical metal. But here's the hidden truth. Most traders never take delivery. The entire futures market survives because the system assumes that almost everyone will settle in cash or roll their contracts forward into the next month. Historically, only a small fraction, maybe 3% to 5%, ever stand for physical delivery. That's why the exchange does not keep enough silver to cover every paper claim. That assumption is now breaking down. March, silver futures contracts currently represent more than 400 million ounces of silver promised on paper, but the amount of registered silver actually available for delivery inside COMEX vaults has dropped below 100 million ounces. That is a massive imbalance. Even worse, inventories are still draining daily, meaning the available supply could fall closer to 85 million ounces by the time first notice day arrives. This creates a dangerous reality. Hundreds of millions of ounces are being claimed, but only a fraction exists for immediate delivery. And the data shows demand for physical silver is accelerating. Recent months have seen unusually high delivery volumes, even during periods that are normally quiet. February has already recorded delivery rates that are almost unheard of in a normal futures market. When contract holders overwhelmingly demand metal instead of cash, the exchange stops functioning as a paper trading mechanism and becomes a physical allocation crisis. The real danger is simple. If too many traders decide to stand for delivery at the same time, COMEX may not have enough registered silver to meet those claims. That would trigger a scramble where delivery becomes first come, first served, and confidence in the entire paper-silver system could crack. This isn't just about price charts anymore. It's about whether the physical supply chain behind the market is reaching its breaking point. Now here's where this story becomes far bigger than just one exchange running low on inventory, because what's happening inside COMEX vaults is only the surface. The real storm is global, stretching from Shanghai to London, from government boardrooms to corporate supply chains. Most people watching silver think this is just another futures imbalance, a temporary shortage, a headline that will fade, but that's not what the data is showing. For decades, silver futures worked because physical delivery was rare. Contracts were rolled forward, traders took cash, and the system stayed stable. The paper market could expand endlessly because hardly anyone demanded the real thing. That world is disappearing. In recent months, contract holders have stopped playing the paper game. They're standing firm. They're demanding metal. And every ounce leaving the vault makes the next delivery cycle more dangerous. But COMEX isn't the only pressure point. Shanghai's silver inventories are collapsing at the same time. London lease rates have spiked to levels that scream desperation. Corporations like Samsung are no longer trusting exchanges at all. They are told to us we're bypassing the system and locking up silver directly at the mine. Think about that. When industrial giants start securing supply at the source, it's not trading anymore. It's resource warfare. And then there's the geopolitical layer. China controls the majority of global refined silver output, and they've begun tightening export restrictions. Meanwhile, the United States has classified silver as a strategic mineral and is moving towards stockpiling. Two superpowers, one critical metal, limited supply. Now add this final ingredient. March is a primary delivery month, meaning the demand pressure is naturally higher than normal. So February 27th isn't just a date. It's a collision point, a moment where paper promises meet physical scarcity. And when too many claims chase too little metal, the market doesn't just move, it breaks. The question is no longer whether silver is tight. The question is whether the entire paper-silver system is reaching the edge of credibility. And what comes next could redefine the silver market for decades. To understand how the silver market reached this breaking point, you have to look at what has been unfolding quietly over the last 2 years. This is not a sudden event. It is the result of a slow, accelerating shift in the way silver is being demanded, moved, and secured across the world. For decades, the silver futures market operated on a simple assumption. Most participants never wanted physical silver. They wanted exposure to price movements, profits from speculation, or hedging tools for industrial use. Contracts were traded, positions were rolled forward, and only a small percentage of traders ever requested delivery. The paper market was much larger than the physical market, but the system survived because physical demand stayed low. That pattern is now changing. Delivery volumes have been rising at levels that no longer fit the traditional model. Even in months that are normally calm, exchanges have been forced to process unusually large amounts of physical metal leaving their vaults. January became one of the clearest warning signs. Instead of quiet activity, the market saw delivery numbers that were several times higher than historical norms. What should have been a minor month suddenly looked like a major delivery event. That is not random. It signals that contract holders are no longer treating futures as paper instruments. They are increasingly using them as a direct pathway to acquire real metal, and February pushed the situation even further. Delivery demand reached extreme levels, with contract holders calling for physical settlement at rates almost unheard of in a functioning futures market. When nearly all open interest converts into delivery requests, the futures system stops behaving like a speculative exchange and starts behaving like a physical allocation mechanism. At that point, the real question becomes unavoidable. Does the exchange actually have enough silver? The registered inventory, the portion of silver officially available for delivery, has been draining rapidly. In just a few months, vault holdings have fallen by tens of millions of ounces. The psychological barrier of 100 million ounces has already been broken, and inventories continue to decline. This matters because March is not just another month. March is a primary delivery month, meaning demand pressure is naturally higher. Open interest tied to March contracts represents hundreds of millions of ounces of silver promised on paper. Yet, the amount of metal actually available for delivery is only a fraction of that. Even if only a modest percentage of traders decide to stand for delivery, the exchange faces stress. But what makes this moment different is that traders are no longer backing down. Historically, many participants would declare delivery early in the month, then close out positions later or accept cash settlement. The system relied on traders stepping away before final delivery pressure built. But over the last 2 years, the opposite has been happening. More contracts remain standing at the end of delivery months than at the beginning. That means the people demanding silver are holding firm. They are not rolling forward. They are not taking cash. They want the metal. And this pressure is not isolated to one exchange. Globally, silver inventories are tightening. Shanghai has seen major drawdowns, with physical silver leaving vaults at a rapid pace. London has faced its own strain, reflected in soaring lease rates. Lease rates are one of the clearest signals of scarcity. When market participants are willing to pay enormous annualized costs just to borrow silver temporarily, it means metal is not available through normal channels. That is not a healthy market. That is a market under stress. Now zoom out further. Industrial demand for silver is rising relentlessly. Silver is essential to the technologies driving the modern economy: solar panels, electric vehicles, semiconductors, defense systems, medical equipment, and the infrastructure powering AI and data centers. Unlike gold, silver is not simply stored. Silver is consumed. Once it is used in industrial applications, much of it is gone. Recycling exists, but it cannot fully replace the scale of demand being created. At the same time, global mine supply is not growing fast enough to meet consumption. The world has been running structural deficits year after year, pulling from above-ground stockpiles to fill the gap. Those stockpiles have acted as a buffer, but that buffer is shrinking. And the behavior of corporations shows that the smartest players understand what is happening. Instead of trusting exchanges, industrial giants are moving directly to secure supply at the source. Companies have begun locking up silver production through exclusive agreements with mines, bypassing futures markets entirely. That is not something corporations do unless they fear the open market may not reliably deliver what they need. This is resource security, not speculation. Governments are also moving. China has tightened control over exports while dominating refined silver supply. The United States has classified silver as strategically important and has begun shifting towards stockpiling critical minerals. Two superpowers, Bafumsasa competing for the same finite resource, adds an entirely new dimension to the market. And then there's the role of market interventions. When silver surged to extreme highs, margin requirements were raised aggressively, triggering forced liquidations and violent price collapses. Paper prices fell sharply, but here is the key detail. Physical silver continued leaving the vaults even during the crash. The paper price dropped. The physical demand did not. That disconnect reveals the core tension. Price suppression may shake out leveraged speculators, but it does not create new metal. It does not solve supply shortages. And it does not stop those who truly require delivery. This is why February 27th matters so much. It is not just a date on the calendar. It is the next major stress test in a market where physical scarcity is colliding with paper promises. The exchange may survive. Rules may be adjusted. Cash settlements may be encouraged. But every intervention comes at a cost. Confidence erodes, credibility weakens, and more participants seek physical silver outside the paper system. The silver market is shifting from trading to accumulation, from speculation to control. The world is no longer simply pricing silver, the world is fighting over it. And February 27th may be the moment that shift becomes impossible to ignore. So what does all of this actually reveal? It reveals that the silver market is approaching a moment where the paper system and the physical system may no longer be able to pretend they are the same thing. For decades, silver futures have worked because trust filled the gap between contracts and reality. Traders believed delivery was always possible, even if rarely requested. The exchange did not need enough metal to cover every claim because almost nobody demanded the real thing. Futures were treated as financial instruments, not as direct pathways to physical ownership. But that assumption is cracking. When hundreds of millions of ounces are promised on paper, yet less than 100 million ounces remain registered for delivery, the market becomes a confidence game, not a pricing game. Confidence. And confidence is fragile. This is not just about one vault draining inventory. This is about a global shift in behavior. Across the world, the largest players are moving the same way, away from paper promises and toward physical control. China has begun tightening export restrictions while controlling a dominant share of refined silver production. The United States has classified silver as strategically important and is moving towards stockpiling critical minerals. Industrial giants are no longer trusting exchanges at all. Instead of buying futures, they are locking up supply directly at the mine. That is not speculation, that is preparation. It is what happens when the market begins to sense that physical availability is no longer guaranteed. Silver is not optional for the modern world. It is embedded in nearly every major technology shaping the 21st century. Solar panels, electric vehicles, semiconductors, defense systems, medical equipment, and the infrastructure powering AI and global communications. Unlike gold, silver is consumed. Much of it disappears into industrial use, never returning to the market. That means supply is not just about mining. It is about replacement, recycling, and the shrinking buffers of above-ground stockpiles. And those buffers have been drawn down for years. The world has been running persistent silver deficits, using stored inventory to fill the gap between production and demand. That worked when inventories were deep. It becomes dangerous when inventories are thin. Now add the future system on top of that reality. The paper market can create unlimited claims. Contracts can multiply far beyond what exists physically. The system survives only as long as most participants accept cash settlement instead of delivery. But what happens when more people want the metal? That is the stress test approaching on February 27th. Even if a formal default never happens, the consequences of stress are enormous, because once the market realizes that physical silver is scarce, the pricing mechanism changes permanently. Industrial users accelerate off exchange deals. Investors demand allocated bullion. Governments compete harder for strategic stockpiles. The exchange becomes less central. The physical market becomes king. This is why February 27th matters. Not because it guarantees collapse, but because it may expose the true condition of the silver market more clearly than any moment in decades. A market where physical demand is rising, inventories are shrinking, and the world's most powerful institutions are quietly positioning for scarcity. The question is no longer whether silver is tight. The question is whether the paper system can continue to function as trust erodes. Because when confidence breaks, the shift is irreversible. The world stops trading silver. The world starts securing silver. And February 27th may be remembered as the moment that reality became impossible to ignore. Now I want to hear from you because this is bigger than just numbers on a screen. Do you think COMEX survives March smoothly? Or are we witnessing the beginning of a historic shift where physical silver finally breaks away from paper control? Drop your thoughts in the comments. Are you watching physical bullion, silver miners? Or are you still focused on futures and ETFs? Because the next few weeks could reshape this entire market. And here's the reality. Most people have no idea this is happening. The mainstream financial world treats silver like an afterthought. But the data is telling a different story. Record deliveries, inventories collapsing, governments tightening control, corporations locking up supply. This is not normal. So if you found this breakdown valuable, share it with one person who owns silver, or one person who should. The more people understand what's happening beneath the surface, the better prepared they'll be. And if you're new here, make sure you subscribe, because we track the real signals, not the headlines. The next update after February 27th could be one of the most important silver market developments in nearly half a century. Stay sharp, stay informed, and stay ahead of the crowd. Because here's the final question that keeps hanging over this entire story. What happens when too many people demand what the system cannot deliver? The paper market can promise unlimited ounces, but the vaults cannot. And every delivery cycle is making that gap wider. February has already shown extreme physical demand. March is a primary delivery month with open interest that dwarfs available supply. Shanghai is draining. London is strained. Industrial giants are going directly to mines. Governments are treating silver as strategic. The trend lines are converging. And February 27th is the next collision point. Maybe the exchange holds, maybe rules are changed, May contracts are settled in cash. But every one of those outcomes leads to the same conclusion. The world is waking up to the reality that physical silver is finite. And once the market fully realizes that, the pricing mechanism changes forever. So the clock is ticking. 10 days, one decision for every contract holder. Roll forward, close out, or demand the metal. And when that choice is made, we find out whether the paper market still controls silver or whether the physical market finally takes over. February 27th is coming, and the silver market will never look the same again.